Hello, and welcome to our channel. Are you looking for a way to increase your profitability in the stock market? You are in the right place, as today we're diving into technical analysis, specifically focusing on a powerful tool called candlestick patterns. So, grab a notebook and pen because we're about to embark on an illuminating journey into the realm of candlestick patterns. Before we begin, take a second to hit that like and subscribe button below to show YouTube algorithm that you enjoy learning about this content. It also helps us deliver more valuable information to you as we build our wealth for 2024. Candlestick patterns, graphical representations of price movements within a specific time frame. They're named after their likeness to candlesticks, with a body indicating the opening and closing prices, and wicks highlighting the highest and lowest prices during the time frame. They offer a treasure trove of information and can help you decipher market sentiment, becoming a powerful weapon in your investment arsenal. We embark on this exploration by grasping the fundamentals. When we mention candlestick patterns, we're alluding to diagrams that embody the erratic movements of prices within the stock market. They are not just simple graphic representations, they are an elaborate tapestry narrating the story of the financial markets. Their adoption in Western markets revolutionized the way traders read price fluctuations and market sentiments. Each and every candlestick that finds its place on a chart unfolds its own story. This is an epic chronicle about the constant battle between buyers and sellers within a specific duration. This ongoing struggle transpires at various time scales, from a mere minute to an entire day or even more extended periods. Let's scrutinize this particular candlestick. Pay attention to its structure. It is formed of a body and two wicks, or alternatively called shadows. This structure is not arbitrary. Each component provides crucial insights into the market dynamics. The essence of a candlestick lies in its body. It demonstrates the price range between the opening and closing prices during the chosen time frame. This range provides a glimpse of the market's heartbeat, captured within the trading hours. Now let's shift our attention towards the wicks, or shadows of the candlestick. These slim lines that extend from the body of the candlestick hide valuable data. They exhibit the maximum and minimum prices reached during that time frame. Much like the peaks and troughs in a landscape, these wicks highlight the extreme points of the trading journey. So, as you delve deeper into the intriguing art of understanding these Japanese candlestick patterns, remember this: every candlestick is a testament to market sentiments, a chronicle of the aggressive dance between demand and supply. Now let's revisit this candlestick. It comprises a body and two wicks, or shadows. The body signifies the price range between the opening and closing prices during that period. The wicks reveal the highest and lowest prices reached. 1. Doji. The doji signifies market indecision. It's not just a term, it's a symbol, a beacon in the world of financial trading. In essence, a doji candlestick is like a moment of silence in the midst of all the noise, an indication of a potential change. It offers a brief pause, a moment where the market takes a breath and stands at the precipice of a new direction. In a realm where every decision matters, where every uptick or downtick can mean a difference in millions, understanding the significance of a doji is vital. Traders from all around the globe, be it in bustling Wall Street trading floors or the tranquil solitude of a home office, watch out for this sign. The appearance of a doji is a whisper of caution, a subtle hint to traders that the market might be about to shift. Now, to understand how this plays out in real-world markets, let's take a look at some historical examples. Back in July 2010, the S&P 500 index chart formed a doji. After a strong uptrend, the appearance of the doji indicated a potential reversal, and, sure enough, the market shifted directions soon after. Similarly, in February 2012, the gold market saw a doji formation after a prolonged downtrend. Traders who recognized the pattern adjusted their strategies accordingly, and were prepared when the market made a significant shift in direction. When a doji appears after a strong uptrend or downtrend, the implication is even more significant. It's like a sudden silence after a loud crescendo, or the calm after a storm. It suggests a potential reversal, an about-face, a change in the market's current path. It is a moment where the bullish and bearish forces collide and come to a standstill, leading to an equilibrium state. The doji isn't just a signal, it's an invitation to traders to step back, reassess their strategies, and prepare themselves for a potential shift in the market's direction. It's a silent whisper in the trader's ear saying, "Hold up, change might be on the horizon." Traders often see it as a signal to prepare for a change in direction, And these real market examples prove how accurately a doji can predict a market shift. 1. Hammer. The hammer is a bullish reversal pattern that signifies a potential shift in market power from sellers to buyers. This pattern is colloquially named for its striking resemblance to a traditional hammer, with a short body at the top and a long downward swinging lower shadow. It emerges as a beacon of hope for investors in the depths of a lengthy downtrend, resembling a ray of light at the end of a dark tunnel. The hammer pattern's formation is its distinguishing characteristic, providing insights into the market's underlying dynamics. Its formation occurs when the market has been wallowing in a protracted downtrend. Despite the sellers dominating for most of the trading duration, the buyers manage to muster sufficient strength to push the prices upwards, thus overpowering the sellers. The sudden influx of buying pressure can be attributed to several factors. It could stem from optimistic news that stirs positivity among investors, undervalued asset prices that lure bargain hunters, or simply a state of sellers' exhaustion. The root cause may vary, but the outcome remains consistent. The buyers have re-entered the market, signaling a potential alteration in the market's direction. While the traditional hammer pattern is noteworthy, its variations, the inverted hammer and hanging man, add layers of complexity to its interpretation. The inverted hammer, like the classic hammer, forms after a downtrend and signals a potential bullish reversal. However, its long upper shadow implies strong selling pressure during the trading period, highlighting that the battle between bulls and bears is intense. On the other hand, the hanging man resembles the hammer, but occurs at the peak of an uptrend. It hints at a potential bearish reversal, as it reflects the seller's attempt to drive prices down. Despite the bears' efforts, the bulls manage to pull the prices back up, leaving a long lower shadow. In conclusion, the hammer and its variants are key patterns that indicate potential trend reversals. They signal a power shift from sellers to buyers, hinting that the bulls might soon take charge. Yet, it's crucial to bear in mind that these patterns can only suggest a possible trend shift, but they do not substantiate it definitively. They serve as alerts for traders, pointing out that the tides might be changing. 1. Engulfing pattern. The engulfing pattern consists of two candles where the second candle completely engulfs the first. A bullish engulfing pattern suggests a potential bullish reversal, while a bearish engulfing pattern indicates the opposite. 1. Shooting star. The shooting star is a bearish reversal pattern that appears at the top of an uptrend. It signals potential weakness in the market, with sellers gaining control. Remember, when you spot a bullish candlestick pattern like the hammer or bullish engulfing, consider entering a long position, anticipating upward momentum. On the other hand, if you encounter a bearish pattern such as the shooting star or bearish engulfing, you might consider selling or shorting the stock, expecting a downward movement. 1. Morning star. The morning star is a bullish reversal pattern that appears at the bottom of a downtrend. It consists of three candles and signals potential upward momentum. 1. Evening star. The evening star is a bearish reversal pattern that appears at the top of an uptrend. It also consists of three candles and signals potential downward momentum. 1. Harami. The Harami pattern involves two candles where the second candle's body is contained within the first candle's body. It suggests potential trend reversal depending on its position in the trend. Piercing pattern. The piercing pattern is a bullish reversal pattern that appears after a downtrend. It consists of two candles where the second candle closes above the midpoint of the first candle. Chapter 11. Dark cloud cover. Dark cloud cover. The dark cloud cover is a bearish reversal pattern that appears after an uptrend. It also consists of two candles where the second candle closes below the midpoint of the first candle. Chapter 12. Three white soldiers. The three white soldiers is a bullish reversal pattern characterized by three consecutive long bullish candles with higher closes. It indicates strong buying pressure and potential continuation of an uptrend. Congratulations, you've unlocked the secrets of candlestick patterns. Remember, mastering trading takes practice and patience. Start by observing these patterns on historical charts and gradually apply them to real-time trading scenarios. And always, manage your risk wisely.